Uh, um, Welcome all. I'm Grzegorz Ekiert. I'm professor of government and director of the Center for European Studies. This is the first meeting of directors seminar for this academic year. Director seminars is a new set of events which will involve a number of panels by leading scholars in different disciplines to explore the issue of the European crisis. We are going to have one in sociology in November, and then a couple of more in the spring. So, you know, as you see here, we are very well prepared on this side of the table. There is a group of scholars who have been shaping the European studies in the US for the last couple of decades, and they are our guests today. Just to open the set of issues we are going to discuss, I would like to start with a quotation from Zygmunt Bauman, who is noted Polish sociologist, expelled from Warsaw University in 1968. Bauman said in 2004, where East European countries joined the European Union, that Europe is not something you discover. Europe is a mission, something to be made, erected, built. And it takes a lot of ingenuity, sense of purpose, and hard labor to accomplish that mission. For the last year or so, it seems that this is mission impossible. Although the members of the Commission are more optimistic, cautiously optimistic, as they say today. The summit, this is not a side event of the EU summit in Brussels, but the summit doesn't look as it's likely to produce a consensus on the major issues. So the topic of today is to explore the issue whether this is mission impossible or not. And our guests today, let me introduce briefly, they don't need introduction. This is the cliche we always use. On farthest to my left is Professor Jacques Rupnik, who comes from Paris. He is a senior research fellow at the Center for International Social Science Research and at Sciences Po. The most distinguished expert on East European affairs in France, but also has done a lot of work on the enlargement process and was the executive director of the Committee for the Balkans for a number of years. His area of expertise are East European politics and Southern European politics, and Professor Rupnik also advised the European Commission and the late president of Czechoslovakia and then Czech Republic, Václav Havel. Then is Mark Blythe, who is a professor of political science at Brown University and specializes in international political economy and published widely on issues of power of the economic ideas, institutional change, and political parties. Then Professor Andrew Moravcsik from Princeton University. He's director of the European Union program at Princeton. His research focus on the European integration, transatlantic relations, and international organization. He is a very noted commentator on European affairs, publishing very often in Newsweek and all the major journals for public policy issues and foreign policy issues in the US. And then our own Torben Iversen, who is the Burbank Professor of Political Economy, who published widely on comparative politics and political economy, major research focus on inequality and the relationship between among capitalism, democracy, and welfare. And finally, Peter Hall, who is a Krupp Foundation Professor of European Studies. Peter's research shaped comparative politics and political economy over the last 30 years. His work on power of economic ideas and variety of capitalism had been seminal. Our first speaker today will be Andy Moravcsik, and the rules of engagements are the following. We will have short presentations by all 5 panelists, then we will have a discussion between them. for another half an hour, and then I will open the floor for questions from the audience. The event will end up upstairs with a very nice reception where you will have opportunities to talk more about all those issues, which I hope will be interesting and controversial in our conversation today. So Andy, the floor is yours.
Well, thanks very much for having me, Jacques. Congratulations on your directorship. It's nice to be back here. I was here for so many years, I found myself on the way down here compulsively looking for my mailbox to check my mail. I used to check it before I came down to these sessions in the late afternoon. I also noticed that the three people at the core of this panel tacitly coordinated on funereal black as their clothing for this panel, and I think I'm going to live up to it. So here goes. I have 3 points to sort of set the table, and those 3 points are the following 3. Be careful what you wish for, you might get it. Second point, when you have a hammer, everything looks like a nail. And third point, politics is a game of mirrors. First point, be careful what you wish for, you might get it. So one way to look at the Euro crisis is it's come about because Europeans got what they wanted. History really matters here. And I think people get it wrong sometimes. You read a lot of journalists and economists who say in retrospect that the primary motivation for monetary integration was some grand political vision, some idea of Europe, some desire to stop war between France and Germany, or to support German reunification back at the time. But I think most people who've analyzed it in a scholarly fashion now agree that those were not the primary motivations, that the process was dominated by heads of state and government, and they had political, economic motivations for what they did. But they were different across countries. You had a set of weak currency countries, notably Italy and even France, also including later Spain, Portugal, Ireland, and Greece, and they primarily wanted to lower domestic interest rates and encourage capital inflows. You had a set of strong currency countries, notably Germany, who wanted to support a traditionally mercantilist trade policy by encouraging exports, and they wanted to achieve this by keeping the real exchange rate down. This has been the heart of German domestic economic policy for 60 years. You remember Peter Katzenstein's essay, for those of you who read this literature, 3 decades ago or 4. The silver lining would also be to strengthen Germany's financial position, its banks, by encouraging outward investment to finance exports. Now here's the important point. Both sides got what they wanted out of this arrangement. We've seen a large German net trade surplus, for a while the largest in the world, even larger than China's, and that's only 90 million Germans, not 1.4 billion Chinese. And you saw interest rates go down in the southern countries. But persistent deficits and surpluses that resulted from that can be stable over time within a fixed currency arrangement only if there is convergence of domestic macroeconomic fundamentals. So persistent disequilibria don't build up. Or only, economists would say, if it's an optimal currency area. The normal way of dealing with these differences, if they arise, is devaluation or depreciation of the currency. And this is not an option within the currency area, or through inflation, differential inflation. That's not an option either in monetary terms. So now, contrary to what historical institutionalists have conjectured, those who created the euro were fully aware that this is what they were trying to do and that they were undergoing a risk in doing it, that they would not achieve this convergence and therefore these problems would arise. They'd simply place different wagers. The Southerners thought that in exchange for modest domestic reform on their part, they would convince the Germans to tolerate more inflation and to grow more. The Germans thought they would convince the Southern countries to converge to tough German standards on inflations, wages, spending, and so on. And both sides thought if something arose, they would work it out down the line. An interestingly pessimistic view at the time, which is probably closer to reality than lots of people were at the time, is Jacques Delors himself, who managed much of the process. Lots of people have said in retrospect that he was a kind of Svengali manipulating the whole process and got exactly what he wanted. In fact, he was completely depressed after it was done. I remember interviewing him in 1993, and he said, this thing is a complete failure. And it's a complete failure because it's a German monetary union that's been had on German terms. That is to say, not enough growth, not enough pressure on the Germans to adjust. All the pressure is on the South. And he turned out to be somewhat correct. So the basic point is this. Governments got what they wished for, but they failed to create the underlying conditions for its stability. No optimal currency area existed at the time they conceived of the Maastricht Treaty. None existed at the time the euro was created. None existed at the time the crisis broke out, and none exists now. And without it, you can't have a stable monetary union over the long term. So that's the first point. The second point, when you have a hammer, everything looks like a nail. Okay, so Europe's faced with this crisis of a lack of convergence and disequilibria, where you have deficit countries and surplus countries. And the basic problem is convergence. Now, as Keynes pointed out, when there's divergence between creditors and debtors and it triggers a crisis, creditors usually have more options in the short term. It's debtors who run out of credit and are forced to adjust. And indeed, Germany has so far enjoyed low interest rates, high surpluses, relatively high growth, and a lot of policy options. And we read about what's happening elsewhere. The question is this: is the EU solving the problems that need to be solved, or is it just solving the problems it knows how to solve? Does it have a hammer and it's just going and pounding nails, or does it actually have the tools it needs to solve the problem? I'm going to argue it has a hammer. Europe has been good, better at least than we might expect, at short-term crisis management. It's kept the poorer countries liquid by lending money. Obviously, it could have done more quicker, and you can always criticize people after the fact. But I think we'd have to say in retrospect, it's surprising that the system has proved as flexible as it did, creating funds, and even moving toward various kinds of oversight. But you can't solve fundamental structural problems this way. So what's being considered now? Well, what's being considered now are two Bs: budgets and banking. So what the European Union proposes to do is put broad oversight over the budgets of southern countries and to reform the banking system of European countries, put them under a single supervisory mechanism, the so-called SSM, and perhaps create a deposit insurance scheme. Now, there are lots of difficulties with this, how you manage those who are in and who are out, legal status, moral hazard, and so on. The point I want to focus on, however, is this: that this is actually where we hear hammers hitting nails, because banking and budgetary regulation of this kind are insufficient. They don't deal with the underlying structural problems that go beyond this. This summer, I spent a fair amount of time dealing with people in the private sector and the public sector who are managing this crisis. And I think almost every single person I heard speak agreed on two things. The first was that the crisis, at least in part, needs to be solved by real adjustment and real reform of economies. Reform of things like wage setting, labor markets and unemployment policies, business practices, corporate governance, the balance between the tradable and non-tradable sectors of the economy, which has lots of implications for how services and other industries are regulated, education, the quality and not just the quantity of government spending, and so on. The country to think about, I believe, in this regard, is not Greece, which at least in a very optimal scenario you might think could be dealt with through budgetary policies that were proper, not Ireland, where you could argue it's mortgages and banks, nor even Spain, where maybe a fundamental financial restructuring could get us most of the way there. It's Italy. What's wrong with Italy, right? It's had sort of the same budgets for a long time. It's not really a severe banking crisis in Italy. There's some bad banks. But what's the problem with Italy? The problem with Italy is it's not competitive, It's one of the great export economies in Europe, and the things required to make Italy competitive again, to make Italy solvent over the long term, are things that require deeply invasive regulation into Italian society of the real economy, corporations, labor markets, and things like that. These things are technocratically complex, politically costly, and inherently decentralized at the national level. The problem is not a lack of fiscal union at the European level or anything like that. It's the lack of viable solutions politically and technocratically at the national level. We don't even know exactly what would need to be done in some of these cases. Were that not bad enough, people agree on another thing, which is this adjustment would need to be symmetrical. It doesn't just happen in weak currency countries like Italy, it needs to happen in strong currency countries or strong creditor countries like Germany. One way to see this is to ask why the lack of convergence in competitiveness between Germany and the South came about. If you look at unit labor costs, which is the normal simple measure of competitiveness in industrial sectors, the EU set an inflation target of 2%, and it's true that the southern countries that we read about in the papers went over it. They had labor costs, unit labor costs going up by 3 or 4%, and so they became uncompetitive over time. But it is also true that Germany's unit labor costs were between 0 and 1% below it. So when the competitiveness difference between Germany and the southern countries opened up over 10 years, it was as much due to Germany diverging from European standards as it was the southern countries doing so. Now, as recently as 6 months ago, when I published a piece in Foreign Affairs, and I said, look, Germany needs to reflate, Germany needs to inflate, Germany needs to do something about its wages, the IMF analysts who've been writing studies peppered me with emails challenging the view that there was any problem. If you read now the World Economic Outlook by the IMF, what do they say? They say Germany needs to inflate by 4%, and they need to change their wage setting behavior, and they need to change the role of tradable and non-tradable sectors for the foreseeable future in order for there to be any chance that this crisis gets resolved. These are the kind of problems that the EU can't even begin to think about how to regulate. So that's the second point, hammers and nails. We don't have the hammers required to solve the problem. Final short point, politics is a game of mirrors. So you hear a lot of talk about democratic legitimacy these days. What's a legitimate democratic solution to this problem? I'm skeptical of this kind of talk. And I think a lot of the incentives that are created in democracies today in Europe are perverse. Politicians in Europe, like politicians everywhere, want to survive in office. And this crisis puts them in a very difficult position. Why? Because they face a dilemma. The simple form of this dilemma is it's costly to stay in the euro, it would be costly to get out, right? It'd be costly to get out because it would create a lot of havoc in the economy. It's costly to stay in because austerity, or in the German case, paying for other people, is an expensive proposition. But it's doubly difficult for politicians because their own populations take a completely incoherent position. The position of every European public is we don't want austerity in the South, or we don't want to pay for other people in the North, but we don't want to get out of the euro. Right? Well, you can't have everything, right? You have to choose. So basically, they want the end, but they don't want the means. Politicians in Europe are going to be under increasing pressure to provide growth, avoid catastrophic risk, and they are not going to be able to do this. But, and here's the key point about mirrors, nobody who wants to survive in office wants to appear to be the person to have killed off the euro. They want somebody else to appear to have been the person to have forced them to do something that kills off the euro. So the Bundesverfassungsgericht, the German Supreme Court, well, it's not our decision, we don't know, it's the government's decision, right? If you're in the Spanish government, the Partido Popular, you've got two factions. One faction that says you should pretend to be thinking about pulling out of the euro because it would be good for bargaining with Germany, and another faction that says you should really start thinking about pulling out of the euro because it would be good. And of course, if you're rational as a Spaniard, you should be thinking that the euro is not going to be forever, but you want somebody else to take the responsibility. And you'd really like it to be Germany, to make you an offer that you can't possibly accept, so you pull out. But Merkel's not going to be forced to be sitting there with a smoking gun when the euro goes up in smoke, right? So the Germans don't make that offer. They make kind of half an offer, and the system limps forward. You'd like the states to hand off to an autonomous central bank, and maybe the autonomous central bank could make a sensible decision, but of course the autonomous central bank is going to go right down the middle because they don't want to be caught in either of those positions either. So to conclude, we're left with a kind of muddling through scenario. Now, the traditional argument for the euro 25 years ago was that there'll be short-term pain of adjustment, but in long term, it's good for you. The argument now is exactly the opposite. Avoid the short-term pain of pulling out of the euro, and that's why we should stay in it. But in fact, nobody can give you a good story in the long term about why it's a good idea. And for that reason, one has to be skeptical. There are really only two alternatives at this point: pulling out of the euro and seeking something better, or muddling through in a kind of European-Japanese scenario based on these short-term mirror political incentives. For the short term, it seems like the mirror alternative is the more likely. Over the long term, I think there's a reason why we're all dressed in black. Thank you.
Okay.
Here on the stopwatch. And starting now. Right. Well, thank you for the invitation to be here. Couple of remarkable things. Number one, I don't disagree with Andy Moravcsik, which is just in and of itself, noteworthy. In fact, I'm going to be...
We disagree in theory, but not in practice.
Exactly. And I'm also going to do something which is perhaps also unexpected. I'm not going to talk at all about ideas or any of the things that people usually associate me with. I actually have a nice line in sort of doing finance for a while. If you look at my CV, you'll find all these sort of articles on finance as well. So this brings me to how I think about the euro crisis, which is a slightly different way. As you know, all these governments have spent all this money, and I kept asking myself and asking other people one question. Well, if that's true, where did they get the money? I mean, if you're going to overspend, somebody's got to give you the money, right? So where did they get all the money from if they've overspent? Particularly in the American case, I find this pretty hilarious. I take Amtrak every day. I would have noticed an orgy of public spending. It simply didn't happen. And it actually didn't happen in the EU either. Ireland's net debt to GDP in 2006 was 13%. Spain's was 26%. Average OECD debt 2007 was going down, not up. So what happened? A few pictures. As we can see, Europe is not in great fiscal health. But then again, neither is the United Kingdom. So why do they get a free pass? Possibly because they've got the Bank of England in their own currency. We'll be getting back to that in a moment. What about some of the other ones? Well, Japan's there, but they've perfected intragenerational debt bequeathal, so they'll keep that one rolling for a little while. And then, as you can see, you've got Greece and a couple of the others that seem to occupy, but no one's really in great fiscal health right across the world. So what is it peculiar about the Eurozone that's really pushing this? So my 3 points are as follows. The first one is you can't run a gold standard in a democracy. You can try, but ultimately you'll fail. The second one is, and this is more to do with the ECB, you can't solve a solvency problem with a liquidity instrument. You can keep it going, but you can't fundamentally solve it. And the last one is, you can cut Greek public spending down to Neolithic levels, and it's not going to do a damn thing for Societe Generale's balance sheet. Because what you're facing at the end of the day is a banking problem. It's not a sovereign debt problem. There is a sovereign debt crisis because of an underlying banking problem, which began in America in 2008, ricocheted to Eastern Europe in 2009, had a big sticking plaster put over it with the Vienna Agreement in 2009, and ended up blowing up in Europe in 2010. So let's have a look at how this happened. What about this fine mess that you've brought me into? I do like that picture, just for the sake of it. Nice juxtaposition. Right. So what happened? If you've all seen this one before, this is this nice little yield spread and convergence in yields and bond yields, 10-year bond yields, and the interest rates that they pay on bonds, going from 1990 all the way through. So the standard story in political economy is this is about the ECB. It's got credibility. Everybody borrows Germany's credibility. It becomes a very powerful institution, and that basically means that inflation risk and exchange risk have been taken out of the bond, and that's why you see the convergence. Utter tosh. What actually happened was the greatest moral hazard trade in human history. So what does that actually mean? So I'm a banker. I'm sitting around 1993. I see Greek debts out there. I know that I'm taking a risk when I take it on. I'm not going to buy the lot. It's thinly traded anyway. I can't get my hands on a lot of it. But the yield is awesome. It's 25%. And I see it's going down. I see Italian debts going down in price, in yield rather, so Spanish. And this is an important part of my portfolio as I'm putting it together. So I've got to figure out how to make up that yield. Well, I can do a volume convergence trade. What's that? Well, it's very simple. If I know that the bond buying action of other banks is going to cause the yield to collapse, then I fatten up my trading book. I do lots and lots and lots of trades. I buy lots and lots of bonds with a huge amount of leverage. And then I stuff my boots with as many of these bonds as I possibly can. And I get rid of all my nice, safe yield, even lower yielding German and Dutch debt, and I buy as much periphery debt as I can. And then when you do this, the action of all these banks pulling this together actually generates the very thing that you see, which is this yield convergence. Nothing to do with ECB credibility whatsoever. And that's a nice story we tell ourselves, but the banks do this. Now, why would the banks do this? Because on its own, it makes sense. You're going to make a great deal of money out of it. But in doing so, particularly when the euro comes in, you can become too big to fail. You've now become a moral hazard for your banking system. And worse still, once the euro's in and your government doesn't have a printing press, you become a systemic moral hazard because your exposures are interlinked to everyone else. So that nice new shiny ECB, that's going to come to your rescue because you have built a giant immoral hazard generator right in the middle of the European banking system. And so long as everything's fine, no one cares. I mean, what would ever cause all those yields to spike? Well, one thing it did in the way was you've got to have someone buying all this debt, so all the money's going into these periphery countries. And if you give governments free money, what do? They spend it. So what do you see? Ireland, Spain, Greece, and Portugal, way above inflation rate public expenditure. Absolutely, they spent too much. But let's remember where they got the bonds from and what the yields on those bonds and all the people who were advising them from lots of very posh international organizations that this is a good idea to finance infrastructural renewal at this point. Remember in the Greek case that half of the borrowings went on the Athens subway and infrastructure projects. It wasn't all in a mindless party and on swimming pools. This is what does in wage competitiveness. Because you have all this money sloshing around the system, you can afford to give yourself 25% pay rise over that period of time. Otherwise, how would you be able to do it? Unless you have the money coming in. You cannot have overspending unless you have overborrowing, and overborrowing doesn't happen without overlending. It goes back to the banks. This is why you get current account imbalances. Everybody's running some kind of deficit against each other until you get to 2001, when basically the Germans run a surplus. Why? Because in the pressure here is you're trying to converge on a moving average problem. No one can catch up with the Germans. The British have been trying it for a century. They've failed every single time. The price elasticity of their exports is the lowest in the industrial world. They make awesome stuff. You will pay $10,000 more for the BMW. You will not pay $10,000 more for the Peugeot. That matters over the long haul. So Germany runs a massive surplus and everybody else goes into deficit. Why are they able to go into deficit? Because they're buying BMWs. And why are they doing that? Because the banks are giving them the money to do it, which is what creates it in the first place. Which is all showing up in the external debt increases. This is the net international investment position. And what do we find? The people selling the bonds are in deficit and the people buying the bonds are going to be above the line, except for the French, who somehow managed to get it wrong. They're on the wrong side of the trade in most things. But nonetheless, that's where you see it showing up. So if you're selling all this debt, you're going to have a buyer, and your buyer's going to be the one with the positive in net international investment position. Now, where does all this ricochet back to? It goes back to the core banks. These are the exposures of France, the Netherlands, Portugal, Germany, UK, Switzerland, Italy, in terms of percentage of GDP held by core banks as sovereign debt assets from the periphery. Look at France. You're in trouble. You can offset your Greek exposures. You cannot offset all of that. No chance. And the fact that they're repatriating Spanish bonds, 75% are now domestically owned, is simply making the sovereign bank nexus problem even worse. So you have a time bomb in terms of these devalued bonds sitting in banks that run operating leverage of 40 to 1 or more. There are moral hazard bombs for their domestic systems. You can't actually bail them because you gave away your printing press, unlike the Brits. And you can't put them on the balance sheet because you're already running 80% debt to GDP. So if you're in a system where you cannot inflate your way out and you cannot devalue your way out, you've got two choices. Default, which runs all the way back as a bank run through the bond market straight to that and blows up the core banks, or guess what? Deflate. Austerity. Deflation. It's your only policy choice. No one likes it, but it's what had to be done. Now, it's not the only thing that could have been done. There were alternatives, but that's what you have to do if you have a constrained public balance sheet that has to act as the insurance for a national banking exposure, which is international, against a whole system where basically all the banks are lending to each other in what is a foreign currency, because no one really controls it. Now, how much is this going to cost? Assets held by banks, Germany and France, the UK, are double the annual output of GDP. Add it all together and that's what you're looking at. I call that dwarfing the sovereign. There's your exposures. You don't need all of these assets to go bad. When you're levered 40 to 1, all you need is a 3% turn against your core assets. Burn through whatever you've got as your base capital. 7% can render you pretty much illiquid. 10% will render you insolvent. When you've got systemic interlinkages, for example, French banks holding Spanish real estate loans, don't bet against it. It's very, very weak. It's primed to go. So, for comparison, the too big to bail USA, there's GDP at 100, top 6 bank assets only come to 61%. And yet that was too big to fail when 2 brokerages went down. We had to bail them out, and it cost $700 billion immediately and $2 trillion later on. And look, that's 61%. Let's have a look at the Brits. There's the top 4 banks relative to GDP. At least they have their own currency. Barclays Bank is worth more than Britain. Barclays Bank isn't really worth that much if you look at its balance sheet. Germany has a one-bank problem. It's called Deutsche Bank. It's 86% of assets, 86% of GDP is its assets footprint, and its operating leverage is 44 to 1. It's a reasonably well-run bank, but it's tied into everybody else. So Germany has much less problems, but it's still tied in with everyone else's problems. And those problems are here. It's a too big to fail, too big to bail problem. There is absolutely no way that the French state can even bail out on its own Agricole or Paribas, let alone the whole lot of the top 3. So if you have a bank run, this is why you keep the Greeks in. If you have let the Greeks out, you have to liquidate something else in your portfolio to cover your losses. So I want to get ahead of the curve. I dump Portugal. You see me dumping Portugal, you dump Portugal. We all reach for Ireland. We dump Ireland in anticipation of our losses. What do we then do? We're all facing with the decision, do we go nuke on Spain or not? The minute you do, that goes all the way right back to the core bank balances, and you blow up the financial system of the core European countries. Which is why you have austerity politics. You keep the Greeks in at all costs, but you find that you cannot solve a banking problem with budget cuts. It's got nothing to do with it. You can slash it to Neolithic levels, it won't do a damn thing. You can't run a gold standard democracy because, as Golden Dawn and Beppe Grillo and a host of other people we're yet to discover are coming up to tell us, people will eventually vote against it. If the only thing you've got is the eternal recession mechanism as you try and catch up with the Germans, which is never going to happen, default becomes a good option. You can't solve a solvency problem with a liquidity instrument. You can try, it's what the ECB's been doing. But ultimately, at the end of the day, even the unlimited firepower of the ECB is limited. Because in a fiat money system where you're not covered by gold, you need to have something the EU doesn't have: citizens. The US does. It can do intergenerational taxation to back up its paper. The EU doesn't even have that. We're figuring that one out too. And finally, outcompeting the Germans is a moving average problem. You're not going to do it. They're just too good at making things. And stop expecting them to bail you out. The exposures are too big. Austerity is not helping. Everybody who's undergone an austerity program now has more debt rather than less. Even the shining examples of the Balts. Latvia has 4 times the debt that it started with. No one ever talks about that in the great success story for austerity. And they're not even back on trend to growth from where they were when they started back in 2009. So the essence of the euro problem was, it was lousy economics in design, no real lender of last resort, no unified bond market, can't bail your own backs. Deflation is the only option, and you've built a bondholder bank run into your bond market. And it's a fantastic tail risk generator. Current treaty initiatives are politically time inconsistent. What do I mean by that? Well, it would all be safe if we had a fiscal treaty. Absolutely true. Which is a bit like saying the following: would you like to go on a date with me? Sure. Okay, so long as we get married first and have kids. That's the politically time inconsistent proposition. It addresses the wrong problems. They're pro-cyclical. So, for example, if everyone runs a debt break all at once, the ability of the system to generate debt is absolutely curtailed, along with growth and employment. Italy, exactly as Andy said, is thinking of not being Spain. Spain is thinking of not being Spain too. If you'd said to someone 3 months ago, what's the chance of a core European country ceasing to exist, you would think that that was a very long shot indeed. That's the tail risk that we're generating.
Yeah, thank you very much for inviting me as well. As I was listening to Andy going through his presentation, I realized that even though Andy hasn't been here for a long time, it seems like we must have been talking about this all the time somehow. You know, we tend to think about this in very similar ways. Let me propose a way of understanding what is going on in the Eurozone right now, as a contrast to a very common view in the U.S. about what is happening in Europe, which is represented by Paul Krugman. Paul Krugman refers to the European problem as Europe's austerity madness. Okay. And he does that because he thinks that what we're in right now is a Keynesian crisis, right? A Keynesian demand crisis. And the way that you solve a crisis like that is by expanding demand. And in the European context, what you have to do is you have to mutualize the debt in order to bring interest rates down in Southern Europe. You have to increase government spending by relaxing the fiscal criteria and through north-south transfers, and that might require some fiscal centralization. And above all, you need to ease monetary policy, especially by having the central bank buy up government bonds, which is called quantitative easing. And you know what the response to this is in Northern Europe and especially in Germany, right? This is not going to happen. It's not going to happen. And this is what makes Krugman say this is madness, right? It's like a patient who is sick, and we know exactly why, but the patient doesn't want to take the medicine, right? That's sort of the diagnosis from this side of the Atlantic, at least by Krugman. I think Krugman is a brilliant economist, but I think he's wrong about this. I think this is not about a policy failure. I think there is a major problem of structural institutional imbalance in the Eurozone. And to understand that, we have to understand that the Eurozone institutions were built around a Northern European model of capitalism. And that model is not compatible with Southern European institutions. And this is the fundamental problem in the Eurozone right now. And I know Peter is probably going to say more about this as well. Institutionally speaking, and Andy has already said this several times, the Eurozone is not an optimal currency area as it's defined by economists. The interesting thing is that when you go back to the origins of the euro and to the Maastricht Treaty and all the debate that surrounded those initiatives, there's no disagreement with this. This was completely well understood that this was not an optimal currency area, right? But it was thought, it was expected, I would say it was dreamed up that once these countries got into the same currency, there would be major pressure on governments, especially in the South, to institute reforms of their labor markets, to deregulate their labor markets, to break up the occupations that are overprotected, and to institute tough fiscal rules and budgetary procedures. And of course, this never happened. It never happened because insiders in these countries were opposed to these reforms, and it's still not happening. Nor is there any serious attempt of major debt restructuring going on right now because it's blocked in the north, especially by Germany. And yet, and Andy said this very well, nobody can fathom the breakup of the euro, right? The cost of a breakup would be too great, both for Greece and for the other southern European countries, but also for the northern European countries. So a breakup of the euro is not a real serious possibility. And then we have what Andy is calling modeling through, right? You don't solve these problems. I like to call this the curse of a large bargaining space, and I will be a little bit more specific about this in just a minute. So just very briefly on these two models of capitalism that were brought together in a single currency, and is really the reason for this structural imbalance. In Northern Europe, we have an export sector-based growth model. It's based on coordinated wage bargaining, large wage setters, and a non-accommodating central bank and monetary and fiscal policy, where the wage setters can anticipate that if they are striking inflationary deals, there will be a very, very severe cost. And that induces wage restraint, which is good for exports and competitiveness. On top of this, coordinated wage bargaining means that there's essentially a leveling of wages and cost in the high productivity, internationally oriented sector and in the domestic low productivity sector, which means that competitiveness in the export sector is going up even further, and prices and wages are going up in the low productivity sector. This creates a lot of excess demand for skilled labor in the internationally oriented sector of the economy. And the way that you deal with this is to have a very well-developed and well-funded training system that brings people, workers from the domestic low productivity sector into the high productivity sector, and that just fuels additional competitiveness and export-led growth. So this is what I take to be the Northern European model of capitalism. Southern European model, as it existed then and still exists to a very considerable extent, is very, very different. They have a pretty sharp division between a formal and informal sector. This applies to different degrees to different Southern European economies. But they all tend to have strong but uncoordinated unions in the formal sector. And in that setting, non-accommodating monetary policies of the North European variety simply will not work. You cannot deter wage inflation in that kind of setting. And so what you do is you use macroeconomic policies as sort of a way of letting out some pressure when these costs are building up. You do that by slightly inflationary policies and occasional devaluations, right? And to make all this work, you also have to have capital controls. In this kind of world, you clearly are undermining the competitiveness of the economy, right? And this is further, the difference in contrast to the Northern European countries, it is further attenuated by the fact that or heightened by the fact that you don't have this intersectoral compression of wages, right? You have very strong unions, high wages, high protections, high benefits in the formal sector, but not in the informal sector, right? So you get a lot of inequality, and all of this is undermining competitiveness. I think in these countries, in the Southern European countries, the whole deal, the whole setup was underwritten by essentially an insider political coalition that excluded to a considerable extent workers in the informal sector as well as export interest. So what happens when you bring these two varieties of capitalisms together in a common currency area? Well, remember what the prediction was by the economist at the time. The prediction of the economist was that Southern Europe would catch up, right? They would reform their institutions, they would become more competitive, and their competitive disadvantage vis-a-vis the Northern European countries would vanish. But this is what really happened. And I was actually stunned at how bad it looks when you look at this. So if you take exports as a percentage of GDP, okay, and if you just average those numbers for Northern Europe and for Southern Europe, export as a percentage of GDP in Northern Europe in the period from 1970 to early 1990s was about 50% of GDP. Okay? In the Southern European countries, it was somewhere between 25 and 30%. If you take the difference between those two numbers, that's the blue line. Okay? So the difference between those numbers in the period from 1970 to the early 90s was somewhere between 20 and 25%, exports as a percentage of GDP. And then you're supposed to, after the Maastricht Treaty is negotiated and all policies are locked in anticipation of the common currency, you're supposed to see convergence, right? Which is that this gap should disappear. Well, look what happened to the gap. It's stunning, right? It goes from 25% to approximately 40%. And of course, the northern trade surpluses are increasing in this period, around 5%, and the deficits are increasing in the southern European countries. And it's only at the very end where we have the financial crisis, right, where there's some convergence. And the only reason for that is that demand is totally collapsing in southern Europe, right? This is a bad deal in that sense for southern Europe. But as both Mark and Andy were pointing out, there's sort of a financial side to this as well. And the financial side of this is that once you got rid of currency risk, the riskiness of buying up assets in southern Europe was much lower. And so a lot of money, of course, a lot of capital was flowing into the southern European countries, and that gave this initial boom in these countries, fueled some of the housing bubble, as well as the financial bubble. And that didn't last, as Mark has very succinctly showed. And once that failed, partly because, of course, the financial crisis, then you get back to the old situation where investors are expecting or building in the possibility that there will be an exit from the euro from these southern European countries, which is exactly the same as the devaluation risk before you went into the euro. So now that advantage of having a common currency completely disappears, and interest rates in southern Europe are rising sharply, even as exports, right, and the deficit on the trade balance is going up. So how can you solve this problem? The first one is a breakup of the euro, and Andy talked about this too. This is clearly something that is viable in the long run, and my own view on this is that the Eurozone was probably a bad idea in the first place. So if you break it up over the long run, you can make things potentially work better. The problem is, and Andy also put this out very well, there's a very, very high short-term cost of doing that. So everybody is scared of this cost, and that's why we keep the euro. The second solution is significant institutional reform in southern Europe, flexibilize the labor markets, break up the insider protections and the professions and so on. But again, there are these huge short-term costs of doing that, and insiders don't want to carry those costs. And this is even more so now than during the boom, right? Because now if you break down these protections, there's lots of unemployment, and unemployment will only go up. I think if you take away these protections, firms are just going to lay off a lot additional workers, so you get more unemployment. So there's a lot of opposition to that, as long as number one is ruled out, as long as there will not be a breakup of the euro, because I think the insiders are even more scared of not having the euro, right? And they can't buy German products and cars and all the rest. Then the third possible solution is a large transfer from the north to the south, and that would essentially be significant debt restructuring, which hasn't really happened in my opinion yet. I mean, there has been some debt restructuring, but it needs to be much, much more. Sort of kind of a Marshall Plan for the southern European countries. These countries would then recover, and they would start buying North European exports again. This is a solution that is blocked by the northern European countries and German voters in particular, right? They don't see why they need to sacrifice in order to get that solution, as long as one won't happen. That is, as long as there's not a breakup of the Eurozone, of the euro, because that would be really bad, because Germans are actually benefiting a great deal from having a common currency. This is what the figures showed before, right? And so because you can get significant structural reform in either southern Europe or in terms of debt restructuring, you model through, right? This is Andy's point. You get sort of continued austerity. So this looks complicated, but it's very, very simple, and this will complete my presentation here. This is basically how I see what is going on and what the options are for the future. It's basically a bargaining game between the North and the South, or if you want to make it really, really simplistic, you can look at it right now as a bargaining game between Greece and Germany. And what we have in the middle of the figure here is basically a bargaining line where points on that line that are to the right are better deals for Greece, and points on that line that are to the left are better deals for Germany. Now, at some point, these things could be completely breaking down. So if Greece is demanding too much, and if they're not sticking to their commitments and to the conditions that have been laid down for being bailed out and so on, you can see Greece being forced out. So that is what would happen all the way over there to the right. On the other hand, Greece could be forced into so much austerity, right, such bad economic conditions, that even insiders would say it's better to be outside of the euro. But inside those breakdown points, you have a bargaining space. And at the edges of that bargaining space, you see the two solutions that I talked about. Significant Greek reforms, right, but they are being blocked by Greek insiders. Very, very large north-south transfers, basically debt restructuring, that's currently being blocked by German voters. Why? Because they see that there's another solution that would be better for them. This is what economists call, game theorists call, a game of war of attrition, right? And you just try to wait out the other guy to actually make the bigger sacrifice. And then what you get is the middle of the space, perpetual austerity, right? Muddling through, as Andy called it. So is there any ways out of this? Could we ever get out of this crisis? I think, yeah, there is a possibility. And the possibility for getting out of this crisis is, the way I see it, that the cost of austerity and being in this red area of the bargaining space is going to be so great for Germany and the northern European countries that they say, hey, it's actually better to restructure this debt in a major way. And it's going to be so bad for the southern European countries that they're going to say, we're going to have domestic reform. And then this bargaining space shrinks, right? And you get the possibility of a compromise that would involve major debt restructuring and Greek reforms. I think this is the most optimistic long-term scenario that you could imagine. And I don't think this is completely impossible, right? I see this as a real possibility. But you could also just get stuck in this permanent austerity. And if the conditions are not getting worse for Germany and Northern Europe, right, it could get so bad for, I think, especially two countries, France and Italy. They're major players in this system. And if they feel that they cannot live with this permanent austerity, I could imagine that they take their case to Germany basically as an ultimatum. Either there's a complete breakup of the euro, or Germany has to accept a renegotiation of the euro, which would be that governments are allowed to raise their deficits, EU fiscal policy would be instituted at the EU level and backed by Eurozone bonds, so you essentially have collateralization of debt, and ECB would be allowed, that would require a reconstitution of the ECB, but ECB would be allowed to engage in large-scale quantitative easing. And this is back to Krugman's solution, right? This is Krugman's solution. The problem with Krugman's solution and this solution here is that I think in that case, Germany would say thank you, but no thanks. And then it would break up. So that's why I'm calling this a pessimistic scenario.
Thank you, Torben. This is more seminarium than conversatorium.
Well, I hope we get a chance to attack the other panelists. I'm looking forward to that.
You can start
And yeah, and shortly they will as well. Jacques, thank you for inviting me. It's an enormous pleasure, and I mean this very deeply, to be on this panel with 5 scholars from whom I've learned so much over the years and continue to learn. I just learned quite a bit in the last hour or so. So we've had a number of talks at CES over the last year on the economics of the euro, and we heard some more about that. I think very important points a few minutes ago. But since this is really a panel of political scientists, I'm going to talk about the politics of the crisis. And in some ways, this is harder to talk about. At least I find the economics easier myself. But I'm going to try anyway. And what I'm thinking about, maybe not for coincidental reasons, is, can you pass me my watch? I think that might be crucial. It's right there. Yeah, and let me just see what time it is. Okay. I've been thinking about the 1964 American presidential election when Lyndon Johnson defeated Barry Goldwater. I've been sort of hoping for something similar this year, but it's not materializing so far. Anybody old enough to remember that election, and I see only one or two people in this room who might remember that Goldwater was in favor of many things, and one of them was taking back the Panama Canal. And so there was a quip in 1964 that said, what's the definition of the Panama Canal? And the answer is the Panama Canal is a trench just wide enough and just deep enough in which to bury the Republican Party. And I think the question today essentially is whether European Monetary Union is a fortress, what I would call a chambre sans fenêtre, separating the pays légal from the pays réal, a reference to Third Republic France, a fortress just thick and strong enough in which to imprison the integration process in the European Union for a very long time. And really that's the theme of what I want to talk about. Despite the seemingly universal calls today for more Europe, I fear that the answer might be yes. And I want to say why, even though I'm going to be telegraphic in my 10 minutes here. So it's now obvious that the institutional scaffolding for EMU was inadequate. And Mark Blythe had a PowerPoint that made that point, I thought, very well. And almost everyone in Europe, I think, agrees that if the euro is to survive, it requires something closer to a fiscal union, by which I mean a union in which some budgetary powers, maybe fewer or maybe more, are transferred from national governments to Brussels. And economists often make this point as if it were a law of nature. I sort of wonder, I guess nature looked different in 1992. But the important point is that most national politicians have made this point a centerpiece of their efforts to rescue monetary union. I mean, even Mrs. Merkel now says that the solution lies here. What is needed is more Europe. But I think that widespread agreement on this point obscures very deep disagreement on precisely what it means. And it seems to me that the two key issues that remain entirely unresolved are, first of all, well, what kind of new institutions? And secondly, well, what should these new institutions actually do, right? And it seems to me that in the absence of any kind of agreement on those two issues, the call for more Europe is really simply a smokescreen designed to hide or provide some sort of hidden, sort of overt rationale for further delay. And so it seems to me that if we're thinking about the politics of EMU, the central question really is, can the European member states reach agreement on these issues? On the issue of what does more Europe really mean, what should it mean? Can they implement what most of them now describe as the actual solution to the crisis? The solution is more Europe. Fine, excellent. So can they do that? And I think that there are unfortunately some very good reasons to think that they cannot. I'm not sure they can't, but I want to mention a few of those reasons, three of them in particular, because I think they're illuminating about the politics of the crisis. So first of all, we all know, and several speakers have already reiterated, that there's a deep divergence of views between Northern and Southern Europe, and I'm going to give Ireland honorary status in Southern Europe, about who should pay the costs of adjustment, right? That's one of the big issues. This is a crisis, a debt crisis. Above all else, I think Mark Blythe is right, but it's a crisis in which it's going to be resolved only if someone pays the costs. And Northern European states in particular are reluctant to do this, and in this I think Germany is not alone. I mean, one can find very similar views, as I imagine everyone here knows, in Denmark, in Finland, in the Netherlands. I think in many ways those governments are hiding behind the skirts of Mrs. Merkel, which is hard because she prefers pantsuits, but nonetheless that's what they're trying to do. But Germany is the most powerful player and in many ways a typical case. So Germans are reluctant to get into a scheme that might well see them sending billions of euros south every year for an indefinite period of time. And you may or may not think that that is reasonable. This is something we could debate. But I think the important point is that this seems entirely reasonable from the point of view of many Germans. And it seems reasonable for several reasons. I just want to underline these. First of all, this is not what the Germans signed up for. EMU contained an explicit no bailout clause and a stability and growth pact that was designed precisely to avert this kind of situation. Moreover, as I think we probably all will recall, West Germans spent the 1990s in a very similar exercise, transferring huge sums, effectively about 4% of GDP, to the East every year in order to affect German unification. Here I actually have a slide, I think. These sums are astounding. They're far more than I think any other country has spent over a similar period of time in what you might call regional equalization. And then, of course, in the subsequent decade, in the 2000s, ordinary Germans spent that decade restraining their real wages in order to compete effectively in the new union. Torben just explained to some degree why they were able to do that, but that's what they did, and those steps required real sacrifices. So many of the people who took those steps, who saw their incomes essentially remain flat for a decade, asks, well, why should we now do the same thing for Southern Europe? And they point to the case of Italy, of course, where more than 6 decades of similar transfers, never as high as the German transfers from west to east, but 6 decades of aid to the south of Italy, the Mezzogiorno, have not really resolved the growth problem there. And one can look at Greece and say, oh, well, but it'll work in Greece. But I think we can all see various reasons why that doesn't seem so likely. So the German position on this has a serious rationale and something that is reasonable in both logical and normative terms. But conversely, of course, there's more support for this kind of bailout from the north to the south in Southern Europe. But even in Southern Europe, on the part of mass publics as well as elites, there's growing resistance to transferring more budgetary power to Brussels. Now, at the moment, the Southern Europeans have little budgetary power of their own, but in the long run, they're not any more keen on seeing that go to Brussels than anyone else. This is from a study the Pew Research Center did last March. I think the middle column is rather the third column is really quite striking. Okay, that's my first point. So this is a problem. This is a very deep divergence in views, and there's a lot of reasonableness on both sides of it. Secondly, I think we all have to admit that the initial response to the crisis, the first few months of the crisis, maybe the first year in the north, the short-term response made the long-term problem much worse. So instead of treating the problem as an existential crisis for the European Union, which I think it is, politicians treated it, as I think we all know, as a moral problem, closely bound up with national stereotypes. I think Mrs. Merkel's comments here, it's a little unfair to single her out, but they're just, 18 months ago, they're just absolutely exemplificative of the general tone. Member states have many years of work to do to atone for past sins. This is a particular take on what others might see as an economic problem. So the immediate response to the crisis, although expedient in electoral terms to some extent, made the long-range problem of mobilizing consent for some version of more Europe much more difficult. That's my second point. And thirdly, and less dramatically, but I think not unimportant, is a divergence across nations in how the crisis is diagnosed. That is to say, what do we think the problem is here in economic as well as political terms? So if we think just about Germany and France, and they're the classic cases, but we can generalize this argument, I think, broadly speaking, German economists have long been, I would say always been, skeptical of Keynesian economic doctrines. The Freiburg School has been influential there, but it's not the only school that thinks in this way. They're skeptical that fiscal expansion is really helpful for an economy. They have good reason to think that way because, as Torben could explain to us, fiscal expansion is not helpful for the German economy. And these people attach high value to monetary stability and rule-based economic policies. Their basic economic prescription is that governments should make rules and governments should follow those rules. And this is an economic doctrine. It's not simply an article of faith. By contrast, Keynesianism has always been much more popular in France. I edited a book on this some years ago. I was surprised how quickly the French, who were not always so fond of the British, took up this Cambridge Dawns set of ideas. But that's, of course, because there's a long tradition of state intervention into the economy in France, as we all know. But the point that I want to underline here is that these differences in economic doctrines, which lead to different diagnoses of the crisis, are actually rooted in longer-standing philosophies of governance. That is to say, to generalize a little bit crudely, Germans characteristically see the role of government as one of steering the economy. That's how this is often discussed. They see it as a matter of developing framework policies. These are rules that support a social market economy where the dynamism lies in the private sector. And they've had great success with that view, and it describes very well the German economy. By contrast, of course, the French and many Southern Europeans who often have French views, partly because they were conquered by the armies of Napoleon and then embraced some of the ideas he carried with him, the Southern Europeans, like the French, are much more influenced by Republican philosophies of government. I don't mean George Romney, but I mean a classic Jacobin republicanism, which takes the state to be the guarantor of the public interest, and also, in the modern era, responsible for the dynamism of the economy. Marx's analysis of Napoleon III in the 18th Brumaire is actually quite a good account of how French governments have behaved really well into the 1980s. I could go on, but my point is that the relevant conflicts of interest, conflicts of ideas stem first of all from conflicts of interest and then from fundamentally different diagnoses of the problem. And this matters, all this matters because of the following fact. If we look at the history of the European Union, and here I might have to defer to Andy, who has written eloquently about it. If we look at the history of the European Union, I think we see that at each step, forward movement towards further integration has been sold to the member states as a positive sum outcome, namely as a move that offers gains for every one of the member states, even if it entails some short-term costs. This is the whole idea of a positive sum project. And for the reasons I've mentioned, I think it is proven, and Torben in some ways elaborated, it's proving extremely difficult to sell any solution to the current crisis as something that is not zero-sum, something in which someone wins and somebody else pays. So what we have instead are plans for a banking union that are being emasculated, if I can use that term, with every successive month. We have plans for a fiscal compact. More than that, we have a fiscal compact that requires the member states to enshrine budgetary balance in their most basic laws. So Europe has a growth strategy to which all the member governments currently subscribe, and it's based on two principles. First, the principle of balanced budgets, and secondly, on structural reform to make markets more competitive on the supply side of the economy. That's the EU growth strategy, and here what I'm going to say is going to be a little bit at odds with some of what you've heard so far. But in my view, balanced budgets are exactly the opposite of what the European Union needs at the moment. I think Paul Krugman is right about this. The EMU needs coordinated fiscal expansion in both Northern and Southern Europe. And as a growth strategy, I think structural reform is a mirage. It's a myth. Structural reform, that means making markets in products and in labor typically somewhat more competitive over time, something that, by the way, all of these states have been doing for the last 15 years. Structural reform may well make some kinds of economies more efficient. Probably it would make the Southern European economies more efficient, but it is not going to deliver growth in anything like the short to the medium term. It's a myth. I think European policymakers know it's a myth, but I think they cling to it because they have to have a growth strategy, and there's no other growth strategy on which they can agree. So they all agree structural reform is a good idea. But structural reform is not a solution to this problem in anything like the near term. It might be helpful in the long term. So we're left with a status, I'm probably close to my time, we're left with a status quo, namely a policy that imposes most of the costs of adjustment on the Southern Europeans, where close to 1 in 4 workers are now unemployed. And we all know that it's imposing immense economic strain on the South. But of course, that economic strain is being accompanied by immense political strain. So Golden Dawn, a party whose leaders express open admiration for Adolf Hitler, about the only thing German they really like, whose followers are forcibly assaulting immigrants in their homes and on the streets, is the 3rd most popular party in Greece today. And the most popular party is Syriza, a loose coalition of Maoists, Trotskyites, Social Democrats, other well-meaning people like those of us in this room, whose economic platform favors continued membership in EMU, but no more cuts, which is at a minimum politically unrealistic. And I think anyone who has studied the 1930s, and in some ways Mark Blythe said this, I think anyone who has studied the 1930s knows that there are political dangers here. Certainly dangers of a return to autocratic government in Greece. I don't think that can be ruled out. Dangers of some kind of struggle over regional autonomy in Spain, which may well occur. But I think the more imminent danger, the more real imminent danger is almost more ominous for EMU. And that is the danger that as governments in the South fall, come under increasing pressure, more general strikes, politicians in the South may be impelled to reject the austerity programs of the Troika. And then the North and the European Central Bank will have to decide whether to cut off aid to them or not. And on current impressions, my bet, although it's a difficult bet, my bet is that they would. And then EMU would indeed fail. So the point here is that economics doesn't really rule this world, politicians do, but we can't expect politicians to perform superhuman feats. And in my view, and we can talk about this because I imagine some people will disagree, in my view, the only way, this is my last point, the only way out of this dilemma is for the northern politicians to come to the view that preserving EMU is worth what would in effect require transfer of billions of euros to the South. That might well come in the form of debt restructuring rather than overt subsidies. It could come in the form of the Marshall Plan that Torben referred to. But I think that's the only way out of this dilemma. And I think the only way, and therefore what stands in the way of this, is the capacity of the northern politicians to persuade their electorates that they will gain in the long run from that sort of strategy. Right? And I think it's not inconceivable that they could persuade the electorate of this, but I think that that is more likely to because they would gain. Germany would pay huge costs, as several people have said, if the euro broke up. But I think for them to be able to persuade their electorates that they will gain from this kind of transfer, the situation has probably got to get worse in economic terms, and worse enough to keep the economies depressed in the north. And of course, the paradox here is that if that happens, then the political strains in the South are going to grow, and the Southern European electorates are going to wonder if it's really worth their while to stay in EMU. And Torben provided several reasons why it might indeed not be worth their while to stay in EMU, and I think that those have to be taken very seriously. So we have a paradox. I think that one should never underestimate the capacity of the European Union to muddle through a crisis, and I hope very much it will through this one, but I hope I've given you some indication of what I think are the political as well as economic dimensions of that crisis.
Thank you, Peter. Jacques. Mine will have to wait a bit longer.
Well, coming last, obviously, a lot has been said, and that makes my task both easier and slightly more difficult in other respects. And maybe that way I can perhaps skip my introductory about the subject I want to discuss is how the Euro crisis has changed the perceptions we have in Europe of the maps of Europe and of the dividing lines of Europe. I mean, the title of these talks could be on lines and circles. The Euro crisis has, I hope does this work? No. Well, this is the enlargement. The main divide used to be, for the last years, and especially even in the last decade, through the main issue was the enlargement to the east. So this is a map I have just shown. Another version is here, the successive enlargement, the enlargement to the east. The east-west divide was the main thing. The latest version of it was old Europe, new Europe. Remember that one? Rumsfeldian divide. So that was the main divide. That has been replaced by what everybody else has been talking about here, and that is the north-south divide. And the euro, well, this is how it has gradually grown. Does this work? Yeah, it does. Anyway, so the Euro crisis changes a mental and political map. It has redesigned the divides from east-west to north-south. And interestingly, the East Central Europeans think themselves as Nordic now. You know, I've written for many years about, how Eastern Europe became Central Europe and how Central Europe wanted to go west to Western Europe. Well, here they are in Northern Europe. This is a Polish prime minister who was here last year in February. He said as much in a public talk and in the lunch talk that Grzegorz was moderating, if I recall. In the European crisis, we are part of Northern Europe. And if you contrast that, 20 years ago, Bronislaw Geremek, in a conversation we had and which was published, he said, his main fear was we are coming from Eastern Europe, we are Central Europe, we want to go west, but we may be moving south. That was the fear then. And the comparison with Latin America, you read the literatures then, Przeworski, Klaus Offer, doing economic and political transition at the same time, they're facing Latin American syndrome, maybe they're going south. Well, no, guess what? 20 years after, self-ascription, the new mental map of East Central Europe is Nordic. And to cut a long story short, on all the major debates around the Euro crisis, they are basically on the German line. Not just the Poles, the Czechs, the Slovaks, the Balts, they are basically with variations on the German line. The Slovaks who had the great idea or misfortune of joining the euro just as it was going down, had a governance crisis, and the whole election was fought about. Why should we contribute to a fund for Greece when we are a poorer country than Greece? The average wage in Greece is the minimal wage in Greece is the average wage in Slovakia. So basically, the East Central Europe is on the Nordic line, and the southern part of what used to be Eastern Europe, the Balkans, they are more in the southern, siding with the southern Europe. So you have divides, mental maps changing there. In this north-south, France is obviously crucial, not in the necessarily in the old sense of the Franco-German engine, as it used to be called, of the European Union, but as a bridge between north and south. It does not dispute Germany's primacy as the bearer of Nordic Protestant virtues, but is an indispensable bond between North and South if a positive exit from this crisis is to be found. And all the more reason to do so on the French side. France bears some responsibility for making sure that the southern countries would be part of Euro. You remember the debates of the 90s, the Club Med, etc. France has some responsibility, including for Greece, actually. France was a main pusher of not only of Greece in the EU, but the Greece in Euro. So that is an additional reason why France is directly a pivotal country in this north-south divide. This, I mean, you have discussed, and I will not therefore dwell on the economic asymmetries. There are also differences in political, in economic and political cultures, and that is, I think, what is at stake in the European debates and misunderstandings we see. Interestingly, these north-south divides, Peter has alluded to that, is not just dividing Europe, it's dividing European member states. Look at Spain, the Catalan debate today. Look at Belgium, look at Italy, etc. So divides within Europe, divides within European states, and I mentioned Central Europe and Balkans also divided on this one. The second point is not about dividing lines, but about circles, about the euro and the kind of reforms that are now on the agenda for saving the euro, creating circles, a European federal core, if you want. And what the founders of the euro, Delors, Mitterrand, and Kohl, could not say in those days is openly discussed today. The F word, the banned F word, is suddenly public discussion. Even people who never, I mean, Barroso now has spoken about federation of nation states. He borrows Delors' phrase from 20 years ago, but still, better late than never. So what is interesting about this return of the federal question, of federalism? Basically, in the European integration, we had three phases on this. One, what I would call rampant federalism. That is the federalism of the founding fathers. They were federalists by commitment, Monet and all the people. They were federalists, but couldn't say openly they were. So this was rampant federalism, spillover effect, Jean Monnet method. You know all that. Common market leads to common currency leads to common policy. All this will fall into place. This was, if you want, rampant federalism. Then, in the midst of the euro crisis, we have Mark II, and that's what I would call inadvertent federalism. That is, Merkozy, who are totally opposed to any federalist ideas, who wanted the intergovernmental approach to Europe. That's why they had Barroso, and if they could give him Nobel Prize for innocuous irrelevance, they would certainly have done so. But curiously, during the crisis, they adopted all kinds of moves at each stage, which pushed Europe and the solution in what you could call, in inverted commas, a federalist dimension, but an unacknowledged one. That's why I call it an inadvertent federalism. Now we are in phase 3, when this is now an overtly accepted idea. I mean, Marxists used to have this formula about freedom being acknowledged necessity. I don't know whether this is a correct English translated. Well, now it is in Europe. Federalism is an acknowledged necessity, if you want. You look at what Van Rompuy's team are producing. They're going to deliver their report next month. You can look at what the Westerwelle ministerial task force are up to. I mean, you have the hints of what Sikorsky and Westerwelle have produced in, I mean, the articles they have published recently. This is an we are in openly federalist mode. Banking union, fiscal union, EU budgetary oversight, the institutional reforms that go with it, European power. Now, this raises a number of obvious obstacles or questions. The first and the most difficult is the issue of democracy and sovereignty. If you are talking about budget, an EU budget or a European supervision, you cannot simply leave it to the current institutional setup. The current institutional setup is under the pressure of the market. EU is seen as producing austerity policies without politics, without the democratic mandates. And this idea of policies without politics, this rise of technocracy, elected governments being replaced by technocrats, what has happened in Greece or in Italy, with all due respect to Mario Monti, who's doing wonderful things for Italy. He has not been elected. So this idea that technocracy on one hand and the rise of the populist movements on the other hand are narrowing down the democratic space in this context to produce a kind of federalist proposal would be suicidal, would get absolutely nowhere unless it has clear democratic legitimacy. There you have to really think. You cannot do any longer inadvertent federalism or rampant federalism. No, you have to be very explicit about where you're going. I'm not necessarily saying we're going to get there or it is good. I'm just outlining what is the logic of what is on the table. Never has Europe been more present in our domestic politics as today. Every day, all the issues, all the debates in our countries are about Europe or related to Europe, Euro crisis, whatever. Economic debates, social debates, political debates, everything is related. And a new thing is happening. Europe in crisis is becoming a salient issue in reshaping the political dividing lines right and left. More precisely, the constraints, the European context is reshaping, is dividing both the right and the left. We can see that, we saw it in France with the adoption of the treaty a week ago, but you can see it everywhere. You can see it in Holland, you can see it in Italy, you will see it in Germany after the election if we get a grand coalition. So you have a left, a Euro left if you want, and you have a protest left, la gauche protestataire. Rosan Vallon has written about counter-democracy and the politics of defiance, etc. This is the other left. Or you have, of course, the Euro right and those who are the right-wing populists who oppose both Europe and immigration. Those who come to get our welfare state and those who want to impose us from Europe. So this is reshaping European politics, and that is a major obstacle. How in this context you find space for launching a major European, federalist initiative. Never has it been more necessary, if you want, and never has it been the popular support or the condition for it so lacking. Of course, something that is both necessary and impossible is a definition of tragedy, but we're not, we're not there yet. The other obstacle I don't have time to discuss, but that is interesting since we're talking about political cultures here as well, is that the word federalism means very different things to very different countries. For Germany, there is a good logic. You have German democracy, it's a federal state, and in a federal Europe, all things fall into place. For France, there is no, in the French political culture, there is no space for talking about federalism, and that's why you have Delors' sort of federation of nation states, which is a cop-out, of course, in a way, but this is the only way to bring the word federalism in the French debate. In Spain, federalism as a way to contain secession. In post-communist East Central Europe, federalism is considered as a legacy of communism. Czechoslovakia, Yugoslavia, etc. For Balts, for Czechs, for Croats who are joining the EU, the word federalism is both associated with a legacy of communism and with failure. It's something that has failed. So not exactly a very attractive proposal for those countries. So how would so these are the obstacles, but that is what is on the agenda. And what would the European Union look like? You would have basically Europe of concentric circles, a Eurozone core Europe. You would have of the 17, or less if some were to drop out. Then the EU of 28 or more, for instance, if the Balkan countries were to join, you could then expand to 35 or whatever. And then the third circle would be the neighborhoods, the neighborhood policy that we have discussed actually at the center yesterday. So the idea of a multi-speed Europe as the best way to accommodate diversity and keep the possibility of further enlargement. You have seen that David Cameron, Britain, has already accepted this idea that there are two-speed, and therefore this is not excluding anybody. No, he simply thinks it's a better idea for Britain. The Czechs are totally on the British line on this, and different countries would take different position. The opposite is Poland. If you look at Poland, which for me is the only Eastern European country that actually has a vision of Europe and that has a foreign policy. Now, the Polish foreign minister, who is not somebody who takes the word sovereignty lightly. It's somebody who I've known for 30 years, and I can tell you, I don't know a greater Polish patriot, and I was going to say nationalist, I say patriot, and a very sort of assertive, somebody who cares for Polish sovereignty. If you read his speech in Berlin last year, if you see what he said in Oxford at a recent speech, etc., you have there basically a Polish plea for European federalism. And a federal, he says, you have a common currency, you don't have a common budget and Ministry of Finance. You have common borders, you don't have common immigration policy, etc., etc. He makes a plea for federalism, and he concludes by saying, well, the only country that can bring this about, that can lead in this, is Germany. Coming from a Polish foreign minister. And we want Germany to lead, not to dominate, but to reform Europe, to transform Europe in this federalist direction. This comes from a Polish. This is an entirely new thing. Why? Because he considers the euro crisis, not in terms of cost benefits, in financial terms. He thinks in geopolitical terms. He measures the consequences for East Central Europe of the collapse of euro, of the disintegration or loosening of the European Union, and what that would mean for them, back to the old question between Germany and Russia, and they know the various the variations on that theme. Have I? Okay, Grzegorz is okay. I will skip some of the other related, but this is basically what we are talking about: the federal project. And of course, you may well say, well, how do you combine dividing lines and circles and concentric circles? Concentric circles as a means to accommodate, but can we get this here? As a means to accommodate diversity. And this is what as I couldn't draw the proper map of this, I just borrowed from Kandinsky. Can it get bigger? Okay. Well, this is, if you want, the Kandinsky model, combining dividing lines and concentric circles. You can see that with imagination, the vision thing, as you say in this country, and academic rigor, the lines, etc. It can be done, and I prefer this to the Malevich model, which I had, but I will not show, but you know it. It's white square on white background, and that's blank Europe. That's EU goes blank, and we don't want that, do we? Thanks.
Okay, great. Thank you so much, Jacques. We are seriously over time. I think that... Right. So instead of quarreling between yourself, gentlemen, let's open the floor quickly but please keep in mind that that we really don't have time, so no long commentaries, but really pointed and the nasty questions to the panel are on order. Too many things happened. All right. Let me start off then with a short question which goes back to both what Peter and Jacques said. The pessimism about the Eurozone prevails in that panel. My question is there a contradiction between saving Eurozone and saving European Union? The Polish Prime Minister just 2 days ago said that asking for more Europe and at the same time asking for cutting the EU budget and reform and dismantling the Schengen zone and doing all those other things is quite hypocritical, and there's a clear possibility that EU is not going to survive together with the Eurozone. So is that something which worries you? Andy, yeah.
Well, I'm an optimist about this, and I guess it's based on the notion that I believe that European policies exist in the mind of policymakers and are treated in the real political world largely separately, so that it's rare that somebody would get up one day and say, we're dealing with Schengen or asylum policy or trade policy or the common trade policy in the WTO, and we are going to condition how we're going to act on that policy on the basis of what's happening over here in the single currency policy. So my default position, and I think this is really based on a close analysis of the way the EU has worked over 50 years, is each policy floats its own boat. So there's no real reason to believe that negative spillover is going to happen. And when you read people's stories about it, it's always, people are going to start yelling at each other and calling Germans Nazis and whatever else, and that's going to lead the European Union to fall apart. I don't believe that's going to happen. And now, I think if anything, if this crisis is resolved in one way or another, it's either going to be resolved by the Eurozone falling apart, or it's going to be resolved by something being done to take the pressure off the system. Either way, I think insofar as there is economic spillover, it should make it easier to deal with things like trade. So, I mean, one of the great miracles, really, of the last 5 years is that both at the international level and at the European level, there's been so little protectionism, right? I mean, you're dealing with countries that have 30% or had 30% differentials in competitiveness driven by their currency values, and they weren't putting up large protectionist barriers. And despite these little stories you read every now and then again about people cheating on Schengen, in fact, you didn't see much of that either, right? So why not? And if you got rid of that pressure, then I would think that our default notion ought to be that those policies would be even more stable. So I think most of what Europe has done has been fantastically successful, more successful than any international experiments in the post-war period. It is supported by every single member of the EU. And you're really dealing with a few policies on the edges. I mean, banking regulation in Britain and so on that are called into question by anybody. And so I'm fairly optimistic about the arrangement as a whole, but I think one bad policy ought to be dealt with as a bad policy and settled one way or another.
Mark, you were nodding with approval when Andy was.
Well, the last speaker and the first speaker, I don't really have anything to disagree with at all. I think that these are both very cogent analyses. I don't really have anything to say directly on that question. If you want to move on and take other questions, that's probably most useful.
All right. So, question, yes, please.
Thank you very much to all of you. Several of you underlying structural reforms were mentioned several times. How long would you estimate it would take to, well, implement and then follow through structural reforms? And this obviously being a long-term issue, how long would you estimate that to take?
Would you like to take a stab on this?
No, but I have a PowerPoint slide to show, which is that, I mean, my estimate is a long time, although it depends what reforms. The slide I'm trying to show, if I can remember how to get the whole thing here. Wait a minute, I better just find it right. I tried to calculate in a very crude way, I'm trying more sophisticated ways, whether the Southern Europeans have actually undertaken any structural reform, because there is a kind of narrative which says, which popular in Germany, and here I think it goes beyond the reasonable, which says we worked really hard, we sacrificed to be competitive in monetary union, and we used that first decade productively, and the Southern Europeans wasted that first decade. And I think that there's a real issue here about whether that's true or not, and I've been trying to figure out whether it's true. I just have to find the right slide. I think it's the next one here. Anyway, it's rather crude. Where is it? Where are we here? Yeah, it's kind of crude, but oh, that's really helpful. Okay, just a second. Here, we've just been through the whole thing. Like me to give the talk again? I actually, in other versions of it, I have to say a bunch of things that directly contradict what others have said here, although I'm now rethinking my position. This is the OECD Index for Product Market Regulation, just the change between 1998 and 2003, which is the longest we have it for. You see there was improvement. Going down is good, according to the OECD, that's structural reform. You've got it in France and Germany and the Netherlands, but you've also got it in Italy, Portugal, and Spain. I don't have Greece on here, but there has been a fair bit in Greece. Now, the thing you'll immediately notice, and I'll stop on this point, is that there's farther to go in the South, right? And so there's an element of catch-up here, and you have to take that into account. But nonetheless, it's a...
What does that mean? I mean, product market reforms?
It means making, it's a whole set of it's perfect for structural reform in product markets. It means making, no, I'm not going to do that again.
Like starting a business, they have a whole...
A whole bunch of things that run from starting a business, blah, 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 to, yeah, I can't remember off the top of my head.
Efficiency of
There are about 40 criteria. Yeah, it's not so much governability, but it effectively does represent how competitive your product markets are, how monopoly, size of state holdings, competition policy, that kind of thing. It's a good question because you're.
So to protect, I mean,
yeah, I gotta stop.
When you talk about protections of the professions, right? Clearly something that is
Yeah,
a
yeah.
major issue in many of these countries. Is that
Yeah, not covered. No, absolutely.
No, it's not covered.
No, absolutely not covered.
Or insider protections in the labor market, right?
Just on that topic, and this is very apropos Torben's presentation, I agree with the very broad thrust of exactly what he's saying, that there's an institutional mismatch, and I would say that what my story with banks does is it says why that institutional mismatch persisted so long, because you were able to solve the problem, or liquidate the problem with credit, and then when the credit's revealed, when it's popped away, then the northern economies are much stronger than the southern economies, and this is part of why you end up with that crisis. But I would say there's this slight problem when we refer to this as structural reform. It's a wonderfully anodyne term. And what does it really mean? And I used to refer to this many years ago as the Jeffrey Garrett problem. And the Jeffrey Garrett problem was Jeffrey did this book back in 1998, 1999 that said you don't have to go all the way to zero with globalization. Look at Sweden. And it's true. It's amazing. Lots of taxes and redistribution, does great under globalization, whole lot, blah, blah. Exactly how do you become Sweden? Structural reform. Well, no, come on, seriously, right? How are you actually going to turn southern Italy into Sweden? Structure. Okay, stop saying the words. What does that mean? How do you actually transform an entire set of institutions, cultures, principles, ideas, the whole thing, practices, belief, daily habits, into something completely different? Ireland has one of the most flexible labour markets in the world. It's not helping it very much just now. Cutting the minimum wage in Ireland is not going to give it the magic boost of competitiveness. So this thing becomes, as Peter says, a bit of a, not just a myth, I'd say a bit of a meme for something which is probably impossible, which is actually turning a country that isn't Germany into Germany. It's just a big fallacy of composition, and it's not going to happen.
But I think the important thing is to see that whatever reform, look, there has to be some kind of reforms that converge the country such that basic real economy things like labor costs in equilibrium when you're not in a recession in the South converge over time. And that's why I think these issues of fiscal transfers are a complete red herring. I mean, people talk forever about fiscal transfers and why, the big mistake was there was a monetary union without being a fiscal union. I mean, it isn't right, number one, because it's too much money. The Germans could, they could pay for Greece, but they can't pay for Italy and Spain. Secondly, it's not right because you can pay for them once, but you can't pay for them over and over again. So you have to have some kind of structural reform that gets rid of the basic problem. And it's not the right thing because it's based on an analogy with the United States that's totally wrong. Everybody has this view that in the United States what we do is when some poor part of our country is suffering, because it's deindustrializing, the federal government comes in and says, oh, gee, that's too bad, and we give them lots of money. But that's not what we do. Michigan had for an entire decade negative per capita income growth, negative overall income growth, and negative population growth all at the same time for a decade. And the response to the federal government was, you don't like it? Move to Phoenix. That's the solution that the American federal government has, right? We do not deal with that way. In fact, that's what the economic studies show, is that we have a lot of counter-cyclical funding in the United States, but actually offsetting regional divergences like this, we don't do a lot of that. So I don't think this is a viable solution to move money. That's the only thing I disagree with your view. I think the other half of it has to be the belief that structural reform in Germany and reflating the German economy and inflation can fill in that other half and balance it. So if you believe that there is a structural reform package, whatever it is, in the two halves that can be balanced off each other and then bargained, and they're credible, then you believe in it. But I think all this stuff about fiscal stuff is as you would put it, it's a liquidity solution to a solvency problem.
I totally disagree. I mean, and I'm going to do something unbelievably dangerous, which is I also have to leave. You've heard of the Greek exit. This is the functional equivalent of Greek exit, and it's dangerous for me. But I just have to say that I very much disagree with Andy, whom I otherwise deeply respect, for the most part, anyway. Okay, so where we would agree is that there have to be changes to these economies over the long term to put the South in particular on a stable growth path. And I think that Torben's presentation outlined the importance of this. I think there's a way in which the Northern European economies were ideally suited to compete in EMU, and the Southern European economies were not, for many reasons, but at least partly because they were unable to devalue and they were unable to operate export-led growth strategies, and therefore they can't operate demand-led growth strategies effectively without devaluation. So, okay, we agree that there has to be some long-term structural adjustment. The question then is, what does it, then there's an issue of, well, what should it be like? I think many who advocate structural reform simply want more intense market competition. And while I think that would be I know you don't, but that would be desirable in some contexts. I mean, I think that some of the professions in parts of Europe could usefully, and not to mention the taxi driver profession, which I'm about to attempt to engage in Cambridge, go to the airport, it could be reformed. But if you believe that, as I do, that there might be systematic differences between varieties of capitalism, it could be that the South has to find a growth model that is different than the Northern growth model. And there is, in my view, a very big open question about whether there is a viable Southern growth model and whether it is just as viable in EMU as outside EMU. I mean, that's the kind of question that I think someone like me has to ask. But then the second issue of divide is this issue of Keynesianism. So that's so we agree in the long term then. So we agree in the long term. But you know what Keynes said about the long term, right?
Yeah.
And so how are we going to get to the long term? And I don't think we can get to it without some coordinated reflation in Europe. I don't think it's right to describe that only as a kind of liquidity approach to a solvency
problem. But if you're German, why do you want to throw good money after bad if there's no long-term
You
solution?
don't, as I said, you don't. But if the alternative is disaster. The alternative is disaster. But in economic terms, Krugman is right.
But
I
it's
think.
€1 trillion of disaster, not 3, right? So that would
Wait a
be
minute.
better.
All right. What's the 1 trillion? What's the 3?
No, forget it.
All right. It's been great. I'm really sorry. I really apologize, Jacques.
You know, I have to catch a taxi too.
So you want to respond to Peter?
Do I wait till I go to respond?
Okay, we have 2 more minutes, I suppose.
2 more.
And the question, please.
A few of you mentioned like the immediate responses to the EU crisis, like even evaluated quite positively. But those immediate actions were taken mainly by the European Council, mainly by intergovernmental methods, not methods that we would see as federalists usually. So, like, how does this relate to those to these calls for more federalism or more Europe on the other side?
Yeah.
Passing that one straight down to you.
No, I said that all the measures that have been taken, they were taken sort of ad hoc responses, and that's why they've been often criticized under pressure from the market. And there is, when you create a fund and you do something, and then you're told it's not enough, so next time you do better, you increase the fund or you increase. I think the big difference has been made when not by the EU, not by EU leaders, but by Mr. Draghi. When Mr. Draghi came in, that made a difference. When he injected 1,000 billion euros in the circuit, in the financial circuit in January, well, then that changed the game. That changed the French election, indeed. It immediately translated into politics. The issue of the crisis became less acute and helped Mr. Hollande to win, for instance. But now this is not enough, because Draghi is Draghi, and he has been a key player. Interestingly, he was applauded when he came into the office by the Germans, I think, because they thought he was standing up for. But sorry? They said he's a German, yeah, and he's proving to be a German of a very a different kind, with a broader view, and so he's a key player, and but that is not enough. Now we need, on the political level, to see what are the institutional political reforms that are going to be proposed and eventually acted upon. If this turn out to be simply a game, we're throwing out a report, and nobody will act. This is the other problem within European leadership. This will not happen without European leadership. Look at the kind of European leadership we are having today. None of them, I think, has the stature of proposing. So when they are back against the wall, they take certain measures. But whether they will be able to do the next move, I outlined the possibility and the discussion as it is as of today. And I ended up with a nice Kandinsky model that we're heading for. But the Malevich model is not to be ruled out entirely.
But, federalism is what European politicians say when they need a little cover for what they're doing. I mean, you should remember what Schmidt and Giscard did, who were famous as great federalists, right? Schmidt, the great federalist. In private, they laughed. And then they got out in front of the cathedral and they said, oh, we're doing this for Europe and so on. The fact is, what are European politicians afraid of? They're afraid that the Bundesverfassungsgericht is going to overrule what they're doing. They're afraid the German public is going to get unruly. They're afraid they're not going to have any political cover. So somebody like Barroso, who's got to be the most convinced anti-federalist in all of Europe in a fundamental sense, comes out and says, I'm a converted federalist, right? What he means is, I have a policy here which can't be resolved without some centralization of power, as we've done 1,000 times before, and this is the way I'm going to justify it. And that's the way it's always been in the EU. The number of people who've actually been convinced federalists in any position of power in the history of the EU is about 3.
We can finish without the British voice in this discussion.
I'm not going to opt out. I'm confused by this point about structural reform, and I've just been thinking about the various comments which were excellent. Torben, I agreed entirely with what you were saying, but then it surely begs the question of why Germany signed up originally for the euro, if it is so blatant that we have the institutional contradictions between North and South. They were signing an agreement with the likes of Giuliano Andreotti. Did they believe that somehow these structural differences or institutional differences were stark, but somehow Andreotti and his like would be able to deliver? Let me just make 2 more sentences, if I may. I disagree with Peter on the point about structural reform is irrelevant. I don't think any economist would suggest that structural reform would boost economic growth in the short or medium term, Peter's words. It's obviously for the long term. I think it would have huge symbolic value in a context, for example, in Greece, where foreign direct investment has been absolutely minimal. Doing better on the World Bank ease of doing business scale would surely be an incentive to greater FDI. Final comment. So structural reform is necessary. Structural reform can produce some gains. But of course, the mechanism that the EU has with the Troika and the domestic intervention, seeing some of it in the Greek context, I'm not at all sure. In fact, that's British understatement. I think it is entirely irrelevant, almost, to improve the capacity of domestic institutions to deliver. So the EU has been dragged into a Troika situation and does not have the equipment, technology, to try to improve the institutional structure at home to deliver. But the first point is brilliant. I agree with everything you said. Why then did the Germans sign up, given these blatant differences?
I'm not sure that this could not have actually continued for a very long time, and I'm not sure that if you had some kind of compromise between the North and the South, where structural reform in the South was coupled with major restructuring of debt towards the South, that you couldn't then go back on a sustainable growth path in which you have a lot of you have trade imbalances within Europe, sure. And the surplus countries are sending capital to the South and supporting consumption and housing prices and so on. It's not impossible that you can actually have this going on for a very, very, very long time, okay?
The question was whether originally somehow the Germans were naive.
Well, no, because I think, they probably expected this to be possible to be going on for a very long time. They were not naive. And it was a very good deal for them because they ended up actually, this exchange of competitiveness for increasing competitiveness for the North, ability to export more, which is the whole growth model is built on in the North, and the South getting an influx of capital that they use to buy Northern European products. I mean, it can go on for a very long time, and it can be mutually beneficial. I think we got into a situation here, right, which was a big outside shock, which was the financial crisis, and then it's very, very difficult to solve this problem. But I do think in the combination of some kind of bargain with structural reform in Southern Europe and essentially a transfer from the North to the South, could reestablish some equilibrium that would go on for a very long time, even though these balances would not disappear. I don't think these balances.
Yeah, just one word. Maybe structural imbalance, north and south, maybe they had their calculation and thought it would last forever. But one should not forget, when was Euro born? It was born after, immediately after the fall of the Berlin Wall. And it was meant as a response, as a German response, Franco-German response. Actually, it was very closely negotiated. All the papers are out on that. As a response to the reunification of Germany, the idea that there is a reunification of Germany in a more integrated Europe. That was the deal. And if you look at the Mitterrand call, talks, etc., so it was not just an economic calculation, would the South adjust better, and etc. There was all that, I'm sure. And the Bundesbank had big reservations. But at the end, the politics prevailed there. And maybe it was wrong. That may be your conclusion. But one should not forget the political moment when it was born.
Surely, I can give you a quick answer. I was right in the middle of these battles. Immediately after there was this revolt against the treaty, colonists, public opinion, and the Chancellery organized a number of debates. Your argument is right. It was primarily political. The assumption was it will produce convergence. That was the assumption. You call it naive, but that was, and the argument was political. It was Kohl. You remember some ridicule that Kohl said it's to prevent war coming back to Europe. That was the main motivation. All these north-south calculations, they did not play a role at all. I mean, go back to the debates. Now, of course, there are all these views. They're intelligent. They figured it out, and they would. No, that did not play a role at that time. It was a political argument.
All right.
Was
that
really
true?
No.
It's not true. Right. Okay. Thank you so much. Joining our panelists, this is very difficult task. We'll continue the discussion in the CS. There is wine and cheese upstairs, and still more time for more informal conversations. So please,
No.